Welcome everybody, Mr. Clark here. Today we're going to talk about mortgages and what we need to know about mortgages. So I've put together a few things I think will help. Mortgages are kind of a crazy thing because um, they're probably one of the biggest investments that you'll make when it comes to just a financial burden. Um, when looking at a 30-year mortgage, that's 30 years of paying on something that could be 100, 200, $300,000, depending on the loan amount that you're getting and what money you're putting in coming into the table with. So let's get started going into this. A few things we want to talk about. Let me go ahead and get this pulled up here. A few things that we're going to talk about are well, I've got some terms here. We've got market value, which is the amount for which a house could be sold. Now that's in flux, like all the time. It's always changing, right? You buy a house for 200,000, it might sell for more, and that's market value going up. Or on the flip side, you could buy it for 200,000 and have it go down, and then now you have paid more than what you could sell it for, right? And that happens a lot in the market, and it's really bad as if a number of people in your street start selling for lower values, because then even if your house shouldn't go down because there's nothing wrong with it, it's going to go down. So market value is a huge one. Property tax is another one. So we talk about property taxes or real estate taxes. They're really based on that assessed value. So if your market value is higher, you can expect to have a higher property tax, and that money goes to things government services like schools, libraries, police departments, things like that. So hey, that helps pay my bill, right? Mortgages have a few parts to them we want to talk about today. Down payments. Down payment is essentially what skin in the game you're offering. So the bigger the down payment, the smaller the loan, right? If it's a $200,000 house and you're putting down 20%, then you are putting in 40 grand, right? Well, if you put in 40 grand, then the interest that you pay is that monthly interest rate times whatever you owe currently. We're going to talk a little bit about that going forward and what we mean by that. And so the more you put in now, the more upfront you're paying, the less back end you're going to pay, or at least over the life of the loan. There's two types of mortgages you can typically see. One is a fixed rate and one is an adjustable rate. I would steer clear from the adjustable rate unless you know something and you know in the next 5 years, and that's where I would stick with if you're going to do them, is on a short-term loan. Um, Rates could go up and now you're going to pay more. Rates could go down. Great. That's a risk you're going to take if you want to take that, if you can find it. Um, for the most common mortgage you'll see is a fixed rate, 25, 30, sometimes less. In that 15 to 20-year range, you're getting paid off sooner, but you're going to have a larger payment, right? You're spreading that payment over less time. Foreclosure just really means the bank forecloses on your home. They essentially take possession of it, and they sell it to kind of recoup the cost. Now, their hope is that they can sell it for more than it was worth, but again, they're just trying to get it off of the books, trying to get it off of a liability. And so you don't make your payments on a regular basis. You're evicted, right? They take the home, they sell it. Homeowners insurance really is like any insurance, just designed to cover damages to the house. So if anything gets destroyed by natural disaster, fire, flood, if you can get that option, if it's in an area where you might have a flood, that might be a little pricier, right? And other types of insurance, as well as things within the home, vandalism, theft, all those things kind of fit into that. And depending on the area you live, depending on the type of home, they might require homeowners insurance to have a lot of complexity and a lot of detail in it, rather than just a simple, cookie cutter type scenario. So we're going to begin talking about just total interest. What I mean by total interest is if we are Hal Jordan here and we're planning to buy a home, and we're looking to need at least $190,000 loan. So we've got a down payment. The rest of the loan is going to be 190. Let's say we're putting 10 down. 10,000. That's all we can put down. It happens sometimes, right? And we need the bank to cover the rest. The bank is offering a 30-year loan, so spreading the loan out over 30 years at 6.4%. The question is, how much interest are we going to pay? Well, again, if we look at uh, recalling original monthly payment calculation, where M is monthly payments, right? P is the principal, it's the original loan. R is the rate that we're looking in the form of a decimal, and T is the number of years. We would have another piece in there, N, but we're not, because it's the number of times we compound or the number of times we make payments. either reducing or adding to, right? If you're investing or if you're taking out a loan. N is that number, in this case 12. So we've got our scenario here. Let's see if I can get the right one pulled up. So M again equals our principal. My monthly payment is equal to our principal. In this case, 190,000. And then that's times the rate, which we said was 6.4, so 0.064 over 12. And then 1 plus, same rate, 0.064 over 12. And then to the power of 12 times the number of years. 12 times 30, we're going to have 360 total in there. And all that's divisible. I would put another parenthesis than they have here, just because that minus 1 is going to throw things off if we don't do it right. 1 plus 0.064 over 12, again to the power of 360 minus 1. See, if we don't subtract the 1, if you don't put the parentheses in right, we might get a whole bunch of stuff and then minus 1. Like if you have 500 minus 1, that's 499, not huge. But then we're dividing by a larger number here and then subtracting 1. So we're not doing, it's going to be a weird number. We want to make sure that we divide by this, subtract 1, but we want to do all that stuff inside the parentheses. So I just want to stress that an extra set of parentheses is probably going to be helpful when you do this. So in this particular scenario, when I calculated it out, I got a monthly payment of, let's see, we got $1,188.46. So our monthly payment, that's what we're looking to pay, $1,188.46. If we take that and say, well, we're making that payment for 360 times, right? 12 times a year for the next 30 years. I end up getting a value of $427,845 and some change, 60 cents. Our original loan was for $190,000. So when we look at the total interest paid, again, remember it's like the finance charge. We're looking at the finance charge. We're just subtracting the difference between those. And when I do that, I get about, what do we got? 237,845.60. I got another table here I built. So you can get calculations found either online. Now mine's not exactly the same. There's some rounding error, right? But this is what's called an amortization chart or table. And every gray bar you see across there is number of years. This goes on and on and on until we get to the end, which is, in our case, 30 years. And notice I've got a line that's going down here and a line going up. I didn't bother to label the legend of this, but this orange line is the amount we're paying to principal. And this gray line is the amount we're paying to interest. Notice over time, if you go to the very top here, our monthly interest is going down. Every month we pay just a little less, because what we're doing is we're taking our monthly interest, so that's this right here, and we're multiplying that by the current loan balance. So the very first one, 1,013.33, was that rate times that 190,000. So we took this rate times this, and that gave us this interest. Now the monthly payment is just that calculation like we did, and when I subtract those, I get the monthly principal. Again, every time we pay part of this principal down, our loan balance is going down. So when we take that same rate, that MPR of 0.0053, repeating, and multiply that by the current balance, the numbers are going to get smaller, but we're fixed on our mortgage payment. Our mortgage payment is still the same all the way through, which means more and more and more is getting paid to our principal, and less is going to interest. And over time, they eventually break even, and we find ourselves paying off the loan. That's what that table is. You can find that on Bankrate. You can calculate that online and most other sources too. Any lending website will get you something like that. And they can get you, a way to kind of fine tune that, if you will. So that's the first one. Monthly payments. We got Barry and Iris are buying a home in South Central City. They're required to pay homeowners insurance, property taxes, and mortgage all in one go in a one monthly payment. So the bank just wants it all together, and that's common. So when we take their mortgage of $1,233.56, they're taking a semi-annual property tax bill of $5,206. So semi-annually, which means every 6 months, which means we're going to divide that number by 6 because we want to know monthly. And then their annual homeowners insurance is $1,080. Again, we're going to take that and we're going to divide that by 12 to get monthly. And so when we look at this problem, we have that first that the homeowners insurance is $1,080 divided by 12. I've got $90 for that. The property tax we said was $5,206. When you divide that by 6, again, that's happening every 6 months, I get $867.67. And then our mortgage payment right here. So when we add all three of those together, when we add them all up, we get a total, I'm going to call it total monthly, I can spell, total monthly of $2,193.23. That's my total monthly. Oops. And so I think about what we're actually paying to the bank every month. Our mortgage payment was, not as bad. It was $1,200, but we now are paying this other money that's coming in, and so our monthly payment has shot up almost $1,000 more. A couple of things we want to talk about: front end ratios and back end ratios. First of all, for front end ratios, when we talk about Peter and MJ Parker, they're considering buying a house and researching potential costs. Their AGI, so adjusted gross income, is really just your income after any deductions, like the standard deduction for being married, the $24,000 or whatever it is for your filing status. That income is what we want to look at, and banks consider that and say, what is your income? We want to know that value when it comes to that that piece and your total monthly your total monthly housing expenses, because we want to say how much are we spending out of our total income just for housing. Typically, most banks are looking for 28% or less, and honestly, that's going to fluctuate with time. Economy changes a lot of these things, and it's really dependent on a lot of values. But in general, the lower, the better. And so when we look at our property tax, our monthly insurance, mortgage payments, those are all monthly housing expenses. We have to count for all of those. So first of all, our monthly property tax, we want to look at that. So in the example, we're told that our property taxes are $9,400 annually. So we divide that by 12, and I got $783.33. Again, they're going to round to the nearest penny. They're not going to go on forever with that. They're just going to net round to the nearest penny. Our property insurance, we said, was $876 a year, so divide that by 12, and I pulled $73. And then our monthly mortgage payment, so we're looking at a monthly mortgage payment. It's given in the description. We're told that our monthly mortgage payment is $1,233. And so now when we look at all three of these are all of our total housing expenses. We need to add them all up. So we're going to do that here. So we're going to take the 1,233 plus the 783.33 plus the 73, because we just like threes, And we're going to divide that by whatever our, and here's the thing, we got to know what our monthly income is, huh? We didn't check that out. We're going to take this whole thing and divide by our monthly income. And if you take our monthly income, we said our adjusted gross income was $135,511. If you take that value and divide it by 12, I get $11,292.58. So that's 11,000. You know what? Let's clean this up so it doesn't look like a continuation of the same problem here. All right, there we go. So we have the 1,233 plus the 783.33 plus the $73. We're going to divide that by what we said was 11,292.58. Again, when you divide our adjusted gross income, which was this, divided by 12, that gives us that $11,292.58. Right. So now we add those together, and when I calculate this, I get 0.185. or in percent form, 18.5%. Now, is that good? Does that fit what they are looking for? Less than 28%? It is by quite a bit. So by the front end ratio test, we're good. We end up getting 18.5% for that. All right. Roger and Jessica, I should probably specify this as Roger and Jessica Rabbit, looking to buy a home. Try to determine what they can afford and what they can actually afford and what they'll get a loan for. So their AGI is 166,988. Okay, it's more than I make, so they're doing okay. Their monthly mortgage payment would be about $1,500. I think it's $1,544, and their annual property taxes would be $9,888. Homeowner insurance would be $1,007 a year. They also have a $510 a month car loan and an average credit card bill of $5,100. Will the bank lend them $210? Now, real quick, let's just think about this. If they're have an average credit card bill of $5,100, that means that any given month they owe that much money. Now, that is not necessarily saying they're spending 60 grand a year. That just means that they always have it. If they pay it off in full, though, they're spending quite a bit. So it's already not looking good to me, even though they've got that huge adjusted gross income here. Property taxes are killer. So let's look at this one. We need to look at the back end ratio, and we want to say, do they fit the requirements for the back end ratio test? One of the things about a back end ratio is we're looking less than 36%. So this is taking all of our expenses, and they're saying after the loan's done, are you going to be able to hold it? Before it was saying at the front end, do you have enough right now? This is saying, okay, so we loan you now, but what's going to happen in 6 months? What's going to happen in 6 years? Are you going to be able to continue payments on this, or is this going to be over your head and you're going to end up dropping the keys in the counter? That's what happened in 08. People bought multiple houses with no real income to justify it and then couldn't pay it, and they literally left the keys on the kitchen counter and walked out because it was just not where it was just too much, and that's a risk the bank doesn't want to take either, so they're going to consider that. So let's check some things on this. So we're looking for our total. I gotta get my screen up, sorry about that. Total monthly payments or expenses, sorry. And that's being divided by our monthly gross income. So again, this is looking more into the details of what do we spend money on every month, and will we be able to afford this home? So they're going to take all those. Let's go ahead and break that down into pieces that we can answer. Monthly insurance. Our monthly insurance, when we look at this, was the 1,007 divided by 12. So when we take 107 divided by 12, I get roughly 84 bucks. I mean, there's some rounding error, but about $84. Okay. Property taxes. This is the big one. 988. Divide that by 12, and I get $824. So 824 total monthly expenses. Well, our total monthly expenses are going to include more than just the property taxes and everything. We need to add in our credit card piece. We need to add in everything that we have monthly expense wise. We said we also have a car payment, right? So we're going to add all these. That's that $1,544. We're going to add in the $824. That was for the monthly property tax as well. We need to add in the $84 here for our homeowner's insurance. We have a $510 car payment, and we have an average credit card payment of $5,100. So that's a pretty big number. When you add all those together, you get $8,062. Let's see, $8,062. So that's the part that's going to sit in the top. That's our total monthly expenses, 8,062. And then we said that our adjusted gross income, we got to figure that value as well. When you take these 166,988 that we had in the original problem here, this value right here, and divide that by 12, we get a monthly gross income of about $13,916. And that ratio, I pulled 58%. Now, is that less than 36? No, it's greater. So they are probably not going to get the loan. Man, I feel bad for Roger and Jessica Rabbit. That's no good. They're just going to have to go back to cartoon land, right? I probably should write that 13,916 in here so we've got it. There we go. Another option here, we're going to talk about Bob and Linda. Bob and Linda are opening a burger joint. They're excited about it. Bob's excited. Linda really wants to do well. They're going to have competition, right? They're going to have some pesto guy in there, and they're going to have to deal with health inspectors and all sorts of fun things in a business, but they wanted to do well. The downside about a balloon payment, and it's harder to, you don't see these as often, they have different variants to them. One is, that we're going to look at here, is an interest only. What that means is they're only going to pay the interest on the total payment. They're not going to pay anything but interest, and then payment one, the very last payment, they're going to pay the interest for that month plus the principal that they had, so the $300,000. So how do we calculate this one? There's a few things we can do. A normal monthly payment is probably the best thing to start out with. Again, that's that calculation that we did here. That's this formula right there, and we're going to go ahead and write that out. So we take our 300,000, and we're going to take it times, we said it was 0.061, that's monthly. Then 1 plus that 0.061 over 12. Ooh, that's messy looking. Let's clean that up. 0.061 over 12. And then that's going to be to the number of years, which you said is 15 in here, and 12 times, so 12 times 15. And this whole thing right here is going to be divided. 1 plus 0.061. And again, if you got this, just skip ahead. This is just me rewriting the same problem we did in the very beginning of the lesson. Just remember again that minus 1 needs to be done before you divide. And it needs to be done after you've done the 1 plus the 0.061 divided by 12 to the power of 12 times 15, right? You've got to do that first. When I do that, I get a value of 2,500, well, 2,547 and 81 cents, okay? Now they're going to be paying this, if they were just paying the regular loan, they could figure out how much they're going to pay total, what the regular loan amount would be. So let's go ahead and type our normal monthly payment in, 2,547.81. The total amount to be paid, okay, so again, if we're going to be paying this, if we were to normally just pay this, we would multiply that by times 180. It's 15 years, 12 months, so that gives us 180. And when I do that, I get 458,605 and 80 cents. So 456, 605.80. The original loan was 300,000, so the interest that we pay is going to be the total amount paid minus the loan amount. So if we had 300,000 out of the 256, or sorry, the 456, excuse me. I'm realizing I put the wrong number in here. That makes sense. Sorry about that. It's 458,605. I'm saying 458 here where it should be, but I'm writing it in wrong. Throw myself off. We're good. When we subtract 300,000 from that, the original loan, our actual total interest paid is 158,605 and 80 cents. Now that's paid over 179 payments, not 180, because the last payment will just pay the whole principal plus that one interest. So we're going to take that 158,605.80 and divide it by 179, and I get about $886.07. So this means for 179 payments, that's their minimum. That's their payment that they're going to make on a $300,000 loan. They're paying that now. So for the first 179 payments, 886.07 is their payment. On the last payment, after 15 years, they're going to pay the 300 plus that last payment of 886.07. Now notice, if you think about this, keep in mind their payments are low, so they can put more money into their business. But they also have to keep in mind that they're going to have a balloon payment at the end of this. So they also have to start saving now because they're going to get hit with a large payment if they're not careful. So really, that is this lesson. The mortgages are pretty interesting. They're widely useful. The idea is that if you don't have access to the money today, if you think of It's a Wonderful Life, right? We can't spend our whole lives saving and then get enough to pay it by a house, and at that point the kids are out of the house and we only have a few years in it before we die because we're old and we spend our whole time working to save for a home. The mortgage is there to help pay for those homes. Now the question that we want to calculate and ask to ourselves is, are we spending too much on a mortgage? Are we doing too much? And that's really for you to decide what you're comfortable with. You can make the numbers on how long the loan is, what the rate is, how much you put down, and the original loan amount that you're going to borrow, right? All those things are going to play into a factor of what your end goal is and how quickly you can get there, which is to hopefully pay off this house or at least be at an affordable rate with it. If you have questions, I know this video is a little longer, just as always, if you have questions, please shoot me an email. Let me know if there's anything that I can do to help. I want to be able to help you with this. We're starting into the section. We only have a few left. We're almost done seniors. Going to graduate soon and be done with all this COVID stuff. So let me know. Email me. Let me know what I can do to help, and I will work through examples. I have an answer key up in the site so that you can see those and work through those. And until next time, see you later.